Dear students, today we will study the financial system of India. Before we go into detail components of financial system of India, first we must understand the relationship between finance and economic growth, finance and economic development. As we see, blood is important for a body. Similarly, finance is important for a whole economy. For every real flow, there is a counter financial flow in an economy. And long-term relationship between economic growth and finance is seen in data, and finance can lead to faster growth of economy by supporting a productive economic activities, growth oriented economic activities. It can finance important investment in growth areas. Therefore, finance can lead to long-term growth of an economy. And development is also related to finance because development is a broad topic. It includes many factors: transformation of society in various forms, economic, social transformation of society through utilization of resources. So if we want some economic development in some region, through finance we can achieve it. For example, if in South India we don't have perennial rivers, if we want to dig wells, then you can finance those activity and you can provide irrigation facility to farmers in South India. So any economic activity which is absent in certain region can be provided through financing those activities. So finance is related to economic growth and development. And one of the important part that finance plays is the role of economic stability. If financial instability is there in an economy, then long-term economic stability is at stake. So finance can provide supply side support so that goods demanded in an economy are provided through supply. Any bottlenecks can be cleared through financing those activities, and long-term economic stability through prices, rate of interest, exchange rate can be achieved through proper financial policies. The financial system includes commercial banks, the financial institutions, the private banking system, non-bank finance company, money market, capital market, and on top of this there is a central bank. In India it is Reserve Bank of India. So whole financial system includes these institutions, and about 60 to 65% of India's finance is controlled by commercial banks in India. So working of commercial banks and financial institutions is very important for an economy's financial growth. So in India, we have seen that there was a nationalization of banks. That means we wanted India's finance to be controlled by government through Reserve Bank of India, so that Indian financial resources are utilized for India's development, use of resources, and development of India takes place according to our wishes, not according to wishes of the private capitalist system. Therefore, India's banking system was nationalized through Reserve Bank of India Act, and that controls various parts of India's deposit side, lending side, reserves. So from independence we have seen in India the financial system was restrictive. There was control on rate of interest on deposit by the Reserve Bank of India, and there was control on reserves through CRR, SLR ratios, and there are control through priority sector lending, and even lending rates were controlled by the government. So India's financial system was restrictive, controlled by government nationalization RBI Act, and therefore there were many problems in a financial system. Non-performing assets, low capital base of banks, because if you have 100 rupees deposit, you have to keep reserves according to higher CRR, SLR ratios, and then you have priority sector lending that has to be given even if it is non-performing, and there is also a problem of profitability of banks apart from their efficiency. So in the long run, in 1990-91, as India started restructuring economy through reforms, and particularly we wanted Indian industry to be competitive at global level. So it cannot be achieved without financial sector reforms. So in 1996, according to Narasimhan Committee report, finally India started liberalizing financial system, and we gave freedom in deposit rate, in reserve requirements, in lending rates, and made Indian financial system more liberal so that India's banks invest their money according to their decisions, according to profit, so that their profitability increases. And one of the problem of Indian banking system is its low capital base. So overall, a banking system works under if works under a liberal policy, then it can have some profitability. It can lend to important productive economic activities, and certain autonomy can lead to efficient decision by the banking system. We have seen in past about many decades, about 1 or 2 decades, that India financial system has grown a lot, and it has financed various economic activities from infrastructure to important export sectors also. So financial sector is important. On the whole, we can see that if financial system can provide finances adequately according to demand of the economy at a reasonable lower rate of interest, then economic growth can take place in an economy. If we cannot provide finances adequately to various sectors, economic activities, and if rate of interest is very high, then there is a problem of growth in an economy. So if a farmer want to invest somewhere in his farm, he must get at a lower rate of interest, and finance must be available to him at a reasonable rate of interest. So intermediation cost of financial system is very important. If it works efficiently through uh, lower spread, then it can be more efficient. So in a liberal environment, the liberal policy can yield greater result. It has been seen in Eastern economies, especially Singapore, Korea, and Taiwan. The liberal financial policies led to faster growth of this economy. Even Western European countries also saw faster growth due to liberal economic policy. So here we started reforms in 1996, and let us see over a period of time how India performs in this liberal policy. Time being, we can understand the data that India's financial growth had taken place, and it has supported India's reforms agenda, and industries have also grown over a 2-3 decades after 1991. So liberal financial policy is good for India. Thank you.